Okay, welcome everybody. It's Andrew Matner from Altitude Advisory here today. Today I'm joined by our CEO and General Manager of our Wealth Division, Catapult Wealth, Tony Catt, to talk about investment markets and things like that in amongst this coronavirus situation that we're all faced. I know in the Altitude team we've been getting lots of queries and comments and discussion from clients about what's happening in investment markets and interest rates and things like that. So I thought, rather than try and answer all those things, some that I'm qualified to answer, some that I'm not qualified to answer, I thought I'd get the experts involved and invite Tony along for a chat and answer some of those questions. So thank you, Tony, for making the time for us.
Thank you, Andrew, for having me.
Very good. So we've obviously been on a little bit of a roller coaster over the last couple of months with investment markets and things like that. Can you maybe just give us your thoughts on, obviously where we're at, some of the timing, some of the things that you've seen in investment markets over the last couple of months?
Yeah, look, thanks, Andrew. It has been unprecedented, is probably the word that I've heard the most of the last 6 weeks. Unprecedented times, unprecedented events, unprecedented markets. And I think that the number one thing that's caught everyone here, I suppose I'd have to argue by surprise, is the speed of this and the necessity to make change really quickly. And there's nothing that the markets and in any markets they hate more than uncertainty, and that's exactly what we've got right now. And at the moment we're probably coming out the other side to a degree with more certainty about where we stand. But in the middle of March, when the markets, the All Ords hit its lowest point for probably since the GFC, which was 5,400 points. 4,400 points was where uncertainty reigned supreme, and people were extrapolating bad news. So people were, human nature is, you see bad news, you just think it's going to go on forever.
Yeah.
And that was when we saw the lows around of the All Ords in the American markets and European markets in March. As we've started to work our way through that and some of the unknowns have become known, such as and health governments worldwide and so on have worked on this problem, and the Australian government and New Zealand government have particularly done a very good job, is that there's more knowns around where does cash flow sit, what does demand look like in I'll call it an isolation type model, who are the haves and the have-nots. When I say the haves, such as there are certain businesses that have benefited from this whole situation, and there are certain businesses that have suffered out of this situation. So we're slowly working our way through that. And to give you an example of probably where we've got to now is the banks have started doing all their bad debt provisioning. So Westpac and National Bank have done their bad debt provisioning in the last 48 hours. And National Bank has come out and provisioned, I'll call it for a worst case scenario, which includes 30% drop off in house prices, provisioning for a certain level of bad debts and businesses going bust that have, double the GFC type levels. So they've assumed a very, very bearish case. That capital raising they did allowed for that. And what was interesting yesterday is the share prices of all those businesses or the banks actually went up.
Yeah.
So it showed that we're probably close to really, I'll call it scorched earth type scenario being factored into markets at the moment. So hopefully we're closer to the end of this than we were at the start.
Yeah, so we obviously saw that drop to 4,400 and the market's recovered somewhat since. What's, you described the certainty or confidence or information in the market. How do you think that's going to continue to move through the markets over the coming weeks, months, 12 months, whatever it might be? How long before you think we will see, I suppose, some stability or some some reliability in terms of growth or trends in the market?
It's going to be what I would argue is that the market, there are certain parts of the market, such as the banks, oil stocks, which I may be able to touch on today, tourism, travel, airline type stocks, that for them to start to recover, for that part of the market starts to recover, we have to see what I'll call it the new normal looks like.
Mm-hmm.
So Scott Morrison's come out and said that we will not be removing the social distancing rules until we have a vaccine. Well, we may never have a vaccine. And so that's still an unknown, and therefore people still don't know what travel demand's going to look like in 6 months' time. They still don't know what airline demand will look like. They still don't know what number of businesses that are going to go bankrupt. And it's interesting, even with the oil stocks, airlines, I think, comprise of 36% of worldwide oil demand.
Yeah.
So until planes start getting back in the air, and best case in Australia at the moment, they're talking about not till January will our airports even remotely open up to international travel. So, these things are still unknown. So even though I think we're starting to see some sentiment improve, we still have a long way to go to find out what that looks like.
Yeah, okay. And it's interesting. I mean, Tony, you just touched on oil prices there, and we saw some oil futures prices a couple of weeks ago go into negative because of that. The current supply versus demand scenarios that's going on, and I suppose with oil prices as they are at the minute, we've seen fuel prices now. I know in Adelaide in the low 80 cents a litre. For everyone that's struggling on that side, well, there's obviously benefits that come the other side. So, you're in transport or logistics or some of those other industries that, it's not that long ago where fuel was $1.50 or $1.60 a litre. All of a sudden, they've seen their fuel price drop by half. There's obviously, for every loser, there can be a winner as well.
Yeah, 100%. And it is interesting that the unwanted outcome of this is that it might deter the move to electric vehicles and battery technology over the next 5 years. This current circumstance, which wouldn't be great for the planet, but yeah, you're right. There are winners out of that, and even the airline industry themselves, once they do get back up and flying, if oil prices stay at $20 to $30 a barrel, they're a major winner out of that. But I think that you'll see a slow but sure improvement in demand where oil prices will re-normalise back to where they were. So
yeah,
I think that the broader issue is actually with oil prices for me, as I mentioned before, is on where does battery technology and electric vehicles go from here. For me, that's a medium, long-term negative for the oil price once we get through this current situation.
Yeah, okay. Interesting, and we talk about something, and you touched on it before about obviously banks and their provisioning, and I saw National Bank came out and said they've cut their dividend from 80 odd cents to 30 cents. Well, one of the things that I know you talk to your clients a lot about is the importance of yield and cash flow coming out of investments, and worry about that. Don't worry necessarily about the stock price. You bank the income, not the actual capital. If this is going to be a continuing trend, I mean, what impact do you see these, reduced earnings and reduced dividend payouts having on the market as a whole? And then there's obviously those knock-on impacts to retirees or others that rely on those income streams. Have you got any thoughts on that?
Yeah, look, I really do think that it's a temporary phenomenon. I mean, whether we get a vaccine or not, or the banks, the Australian banks particularly are in a 4 times better shape than they were during the GFC. So I think their balance sheets are excellent. I think they're part of the solution, not the problem, in terms of helping a lot of businesses through this issue. And ultimately, they're going to get through this, and whether we're talking a year and a half, that their margins will return to normal, their funding mechanisms will return to normal, and it's my strong belief that in these short-term dividend cuts and things that they're taking is a necessity and I'll call it part of their good governance to protect the shareholders and protect the bank itself. So I think that these are temporary cash flow issues that these companies are facing, and my belief in the medium term, in the year and a half, we won't even be having these conversations anymore. What I will say, though, and we did sort of go through this in the GFC, is that there are some businesses that are going to take longer to recover on that front than others, whether it be travel companies like Flight Centre or things like that. Their dividends aren't going to just rebound in 12 months' time. And like the oil companies are going to take some time once the oil price starts to stabilise as well. So, but on the flip side of that, don't forget that I still think that there are certain stocks like we've seen with Coles and Wesfarmers with their Bunnings stores. There's a lot of technology stocks. There's a lot of stocks that have actually not experienced any real noticeable difference, BHP, Rio Tinto, in their earnings, and therefore are going to continue to pay dividends at the levels they were. So I think across the board, it will be interesting to see how much cash flow is affected.
Yeah, okay, cool. You touched on some sector type stuff there. You mentioned, airlines, travel, retail and mining resources and stuff like that on the other side. And, it's clear that I think to all of us that, it's really, it's probably a case of the haves and the have-nots to a degree at the minute. Now, that to a point, I think or what I understand, probably presents some opportunities in the market as anything. Do you want to maybe shed some thoughts on your analyst view or your research views about which sectors we are actually you feel or you're relatively confident with, and perhaps other sectors that we're not so confident with?
Well, I think the first comment I want to make is that I think that the first thing we're very wary of is Australian dollar. So the Australian dollar dropped into the mid-50s. It's bounced back to 65 cents today as I've seen it, and against the US currency. And after the GFC, what happened was that the American economy, with Lehman Brothers collapsing and things like that, was very in the doldrums, I'll probably call it best put, for an extended period of time. And the Australian economy back then dealt with it better than the US economy did in relative terms. What we saw then in 2009, 10, 11, it was the Aussie dollar recovered back to, I think, $1.10 against the US currency.
Yeah.
We still have an extreme amount of concern, or I'll call it crystal ball gazing, that Australia has handled this in so far so good that we might be able to get back up and running faster than a lot of other economies. The US, it's a bit patchy and unknown in terms of they might need to do rolling shutdowns and other things like Singapore has had to do. So there is some fear at the moment that the Aussie dollar may bounce back up, and it could head back up towards 80 or 90 cents over the next couple of years. So I'm just warning clients to be very careful and aware of that risk, I suppose I'll call it, of the Aussie dollar increasing. The other thing I want to comment on is
just on that before we go on, that obviously then impacts, because I know I've got a number of clients that for whatever reason with their strategy heavily invested in US stocks or overseas stocks. Obviously the currency moving that far is obviously then going to significantly devalue where any gains that might have occurred in those markets.
Yeah, it's a headwind. Yeah.
Yeah.
So you might see underlying share price growth if you owned Apple shares or Google shares or something like that, but you might just be giving that back by the currency movement.
Yeah.
So you need to be very mindful of that over the next couple of years, I think.
Yeah, good point.
It's been a tailwind to some degree over the last 4 years, and that may turn into a headwind.
Yeah.
The other point that I want to make today is that interest rates, cash rates, term deposit rates were already low, and now they're basically going to move to zero for the next 10 years, 5 years. It is so for retirees and people with money in the bank account, for term deposits, you're going to earn between 0 and 1% for a very long period of time. And I think the Australian government 10-year bond at the moment sits at 0.55%. So that gives you an idea of how low interest rates they're forecasting going to remain for 10 years.
Yeah.
That the reason why I bring that up is if that's the case, we're going to wake up in a post-COVID world where people with money in the bank or term deposits, and particularly they can't live off zero income. They can't live off zero growth. Mm-hmm. And so people are going to wake up and go, what do I do with my money? Do I go to the property market? Do I go to a commercial property market? Do I put it in the share market? Those themes, I'm going to call them, are going to come back. And before this all happened, there was a chase for yield because people were saying, well, I can't retire on zero income. I reckon we'll return to that world. So good quality businesses with good quality assets, with good quality income streams will absolutely be in vogue in a post-COVID world. And, that's where I think if we look through the hourglass a little bit, is that whether it be the CSLs or the Macquarie Groups or, the BHPs, or there are businesses, even Wesfarmers, those businesses that have got their balance sheet in order, they've got a good business, they run a good show, they've got a good management team. Those businesses on the flip side of this are still going to be good businesses, and they're still going to be good investments.
Yeah.
So the only other, probably one last thing I'll probably say on that front is things that have absolutely come to the fore in this environment has been technology stocks. So the need for cloud-based, you've seen it with your cloud-based accounting, Andrew, with cloud-based services like Zoom and the way we interact with clients and the way we interact with teams and the way we interact with customers we certainly knew this world was coming, but I think it's been sped up. And therefore, a lot of technology stocks and a lot of innovations coming through the pipeline, which is really exciting. And I think those stocks particularly are going to be really interesting over the next 12 months.
Yeah, cool. Tony, we've seen a bit of noise, I'll call it noise, in the last 24, 48 hours or so regarding, I'll call it, pending fight with China. I know 40, I think it's 40% of our exports or something like that go into China, whether it be resources or wine or education or tourism or whatever it might be. You mentioned before about the US economy and how that reacts to this whole scenario and how long it takes to come back to that. Do you have any views that, given we've got certain companies or sectors or whatever that are reliant on overseas markets, in terms of looking for stability, yields, return, is it going to be, do you see any return to a theme where Australians are focusing on Australian companies doing business with Australian citizens that aren't exposed to export markets, aren't going to be impacted necessarily by currency movements or any of that sort of stuff? Do you see that potentially that there's opportunities there, or maybe an emerging trend in that type of behaviour?
So probably two comments there. I think in the immediate term, Andrew, I think we will. I think we'll see, like after we saw with I love what this whole event, like we saw with the fires, will do to human beings helping other human beings. So I think in the very immediate term, we're going to see people support each other. We're going to support local businesses. We're going to do everything we can to make sure the Australian economy and the businesses within it are operating at an optimum level. So I think that I'm excited. I'm already seeing examples of that, I think, in our own country. And look, I think that will help New Zealand out, where we might open up a lot more opportunity to trade with New Zealand, probably a lot more actively than we have in the past as well, and freeing that up. But I say that with a smile because I see that happening maybe for a while, but no one could ignore the growth market of what China is, and no one, human beings being human beings, they'll chase growth and they will chase the big markets, and I think there'll be a little bit of, in 2 years' time, return to normal activities of saying, okay, well, what can we do globally? And that's okay. If people want to go back to doing that, that's great. I think in the immediate term, we'll look after one another. Longer term, it'll be a return to growth.
Yeah, okay.
And I can't, a little bit of I call it chest beating going on about China being investigated and they're not happy and we're not happy. And I think that's a lot of politician speak and
politicking, yeah,
chest beating, and the reality is business is just business.
Okay. Do you just in that though? One of the sectors that has had a serious decline in Australia in the last 10 or more years has been the manufacturing sector, and I know I've had a lot of clients that have been impacted to some degree with supply issues due to lockdowns and other things like that have gone on. Do you see a potential re-emergence of I won't say Holden, but re-emergence of manufacturing supply chain type things within Australia? And is there any way we can stay competitive in that space, or like you said, are we just going to immediately or as soon as practical revert to the lowest common denominator in line with what has been self-interest behavior, I'll call it?
Yeah, I heard a story about, I think a plumber rang up a radio on this exact topic, and he was talking about, and forgive me because I'm not a plumber, but obviously, and he was talking about a certain bracket that he needed to install parts of his plumbing devices, and to get that bracket made and developed in Australia was going to cost, I think he quoted on the something like $14 per bracket.
Mm-hmm.
He can get the same bracket. Where does cash flow sit? For 38 cents.
Yeah.
Now, as much as you want to support Australia and you want to do things in Australia and everyone, but it's not even a contest if you're talking
Mm-hmm.
about 38 cents versus $14. And I'm afraid that, yes, I think that innovation, like out of the GFC came Uber. We saw a lot of innovation in airports and security technology that came out of the September 11 incidents. And we're going to see an enormous amount of innovation come out of this COVID situation. So I think the innovation is exciting. I think we're just going to go to plain old, we just got to do it in Australia because we need access to it, even though it's not competitive? I can't see us returning to that norm.
Cool.
I think if we can do it in a clever way and do it cost effectively, great.
Excellent. That's good. Some good thoughts. One last thing before I let you go. There's one of the stimulus scenarios, one of the stimulus options that people have been given is early access to $10,000 of their superannuation. And obviously there's going to be certain people out there who are going to actually need that money because they've been stood down from their job and they need to buy groceries and other bits and pieces. There's potentially other people that will just use it as an opportunity to get hold of some money and do something with it, that because they wouldn't have been able to get access to it until they're 65 or whatever. I'm really keen to hear your opinion on I'll call it the short term gain versus the long term pain, or vice versa in terms of that strategy or accessing superannuation monies at this point.
Yeah, look, yeah, you're right. As long as the government's put in place a set of rules to say give you access to $10,000 before 30th of June and $10,000 after. And those set of rules, which I won't go into too much detail today, but, around if you've had certain cutback in hours, if you're employed, or certain cutback in revenue if you're self-employed and so on. If there are some people that will, if you're eligible for it, but don't need the money, there are strategies, and you could probably suggest it's completely legal to take $10,000 out and recontribute it back into the super fund and claim a tax deduction for that. My view, you could take the money out and invest it. My view of all this is you've got to do what's right for you. I think that if you're eligible for it within the rules, speak to your advisor, speak to somebody that knows your situation, think through your long-term goals, think through the tax implications, and it's, whether it's inside or outside superannuation, it's your money. It's your money, it's your future, it's for you to control within the realms of what you have in your life, and you do what's best for you. This whole, don't take it out of super just because it'll be there till you're 60. Yes, but do what's right for you, and make sure you get advice around that. So I'm not suggesting people should or shouldn't get it out, but I'm suggesting they should have a conversation around it.
Excellent, good. One final thing. Sorry, I've made up one more question. and this is a philosophical question. This crisis, as you alluded to earlier, has created a lot of uncertainty, a lot of anxiety for people in relation to that. I'm interested in just one final wrap up. Is this, in your view, does this present opportunities, or does it present a time to, go into your shell and retreat, or, from an investor's investment advisor's perspective, should we be, or should they be looking at the other side of this, or the opportunities that present at the minute? What's your feel on that?
Look, I think it absolutely has to look at it as an opportunity for people that are looking at buying homes, for people looking at buying commercial properties, for people looking at buying into the share market. A lot of us are, I'll call it long-term accumulators of assets, and at the end of the day, you've got to look at the situation and see it as presenting an opportunity to buy good assets at a good time. And ultimately, you're never going to pick the bottom of the markets. You're never going to pick the best time, and you never will. And I don't know what's around the corner tomorrow or the next day, but I do know that at the moment it is presenting some opportunities to buy good assets at good times.
Cool. Well, thank you, mate. That's been great. I think there's been some absolute nuggets of gold in there that you've shared with us. Some great insights that people can take away and review and digest. If they want any more information, they can obviously contact you. Do you want to just fire out your email and contact number for everybody?
So my email is just Tony, Tony, @catapultwealth.com.au, or feel free to ring 8172 9111.
Cool. And if you didn't catch that, anybody, feel free to obviously contact Kristen or myself or one of the other Altitude advisors, and we can connect you with the guys at Catapult Wealth. So thank you, Tony. Thanks for your time.
Thanks for having me.
Cheers.